pull up the page here for the webinar today with Martin. And just to kind of give you a brief, this is the page we're at right now for this event. Just to give you a brief, introduction about Martin and his relationship to Infinity, and how we came across each other and so on. Here's basically what it is. Martin is a customer of mine personally. He has been for a long time now. And I stumbled upon Martin's website through an existing client of mine who had asked me if I knew who he was. And in our business, in the brokerage business, we do a lot of business based on referrals and word of mouth and people talking to each other in the trading rooms and the message boards and Skype and this and that. And so we're always interested in expanding our network of partners. That being said, we are also, we operate in a very highly regulated environment. We care about who we put in front of our customers. We don't just let anyone in the door, so to speak. We work very, very closely with our partners to make sure the information they're providing is valuable. And we pick apart their websites and their material to make sure they're not saying something that violates our regulatory and moral obligations to you. So, whenever I work with a third-party, educating partner like Martin, we spend a lot of time working with them to make sure that the information they're providing, like I said, is valuable, and that they're giving our customers good content in a responsible and appropriate way. And Martin and I struck up a conversation. We started talking a little bit about our program, and he'd kind of heard of our company but never had an account here or anything like that. And we sort of formed some rapport, and I might have had a few other customers who mentioned him to me, so we kind of drove things along. And it got to the point where he became comfortable enough with our charting program and with our brokerage firm, to start working with us on a I don't know, maybe a more official level would be the best way to describe it, meaning we started to do some webinars, and I started to get some good feedback. And I've gotten a lot of positive feedback from my customers about his courses. And I can give you a couple little just personal anecdotal things too. So one thing that I really like that Martin does, he's going to talk about it, I'm sure he will, is he's got a newsletter that goes out in the morning that's called the Rooster Call, all right? And I think that's because he has chickens on his property. I don't know, maybe he can explain that. But it's one of the best written newsletters, in my opinion, that I've seen. It's something I read in the morning, and it's a good mix of all the different commodities, what happened overnight. There's a little twinge of politics in there, but in an easy way to read. Okay, nothing's going to offend you. He's very, very up on geopolitical situation, and it's a very good all-encompassing thing. So if you want to get a little summary of what happened overnight and some ideas to look for the following session, take him up on whatever he puts out there today with respect to the Rooster Call. It's a good, very well-written document. I send it to my management in the mornings. They really like it, and maybe we'll do some more firm-wide with that, but I would really encourage you to look at that. So I find that to be really useful myself, and it's something I look at every morning. And then Martin does this series of classes a couple of times, a quarter or something, and he's going to talk about that, I'm sure, but it's a very reasonable model in terms of pricing. I think he's got good content. He works very well with our program, so I encourage you to listen to him when he talks about his boot camp as well. And again, I've gotten some really good feedback about his teaching ability, and in a whirlwind right now of indicator madness is what I like to call it. Martin sort of brings things down to a moderate level or a manageable level with the way he's looking at the market. It's everyone is trying to make things so complicated right now. It's making my head spin, and I think it's doing the same thing to all my customers. And I think it's a good breath of fresh air to just have a good old simple approach. And that's one of the reasons why we continue to do these events. So I was a little longer than I thought, but I really appreciate him being here. I wanted to get the point across the right way. What I'll do now, Martin, is I'm going to flip the screen over to you, okay, if you're ready, and then you can take it over and get started. So welcome, thank you for coming, and thank you everybody for coming to the event today. And put some questions in that box. I'll be watching, and we'll get started. Thank you.
Okay, can you hear me, Patrick?
Yeah, that sounds good. So we got the mic, and if you just want to pick the screen, it should be, there you go. Okay, we're good to go. Go ahead.
Fantastic, I appreciate it. I want to thank you, Infinity Futures. Thank you, Patrick. And I certainly like to see our charts, so we're going to see all of that in this presentation. I appreciate that introduction. I always maintain 2 trading accounts. And when PFG went under, I waited a long time before I decided to fund again. And that's when I got hooked up with Patrick, who I honestly believe is about the hardest working broker I've ever been associated with. So I definitely appreciate everything you're doing. Patrick, thanks for putting these Sierra charts together for my clients. I really appreciate that. Now, let's just move on. Again, we've got disclaimer here. We're all adults. Everything that I'm mentioning in this recording today, this webinar, is for your educational purposes only. This is a risky business, so please only trade with money that you can afford to use as risk capital. I'm not going to dwell on this page, but it just shows you that I have been around for a while, trading for 25 plus years, over 10 years, full-time trader. And after a while, I just decided to start training people, and I did that starting in 2008. I've done a lot of work with a lot of indicators, done auto trading experience, et cetera, et cetera. And I mean, it's a good business. It's a difficult business to learn. This is me, okay? In the background, sunny Southwest Florida. This is my trading room. Okay, this is where the action happens. Dedicated room. Nice positive colors. They say all that works. I'm going to spend 1 minute telling you what I do, and then we're going to go into an educational webinar where you can immediately start testing. So, it's great information, but first let me just let you know, I do a nightly video. I do this every Monday, Tuesday, Wednesday, Thursday, where we're looking at the charts. What happened today? That kind of thing. I call trades in advance. We work from the right edge of the chart. And on the weekend, I create a Trader Weekly Review, which basically keeps everybody aware of the big picture looking at weekly charts. The idea is you watch and you learn, and through repetition, that's the only way you can really have long-term learning. Patrick mentioned Rooster Call. If you go to my website, hitthemarktrading.com, you can sign up for free 30 days. No problem. I'd love to send it to you. In fact, it probably takes me an hour and a half, sometimes longer, to make this in the morning. It's good read. It's from news from a trader's perspective. Now, Patrick mentioned a boot camp I've got. I've got 2 actually, 2 courses. One is for position trading, and it will mention some day trading. That's called the boot camp. But then this year, I created a class called Just Day Trade. And all we do is intensive focus on day trading. It's 6 hours. It's 6 hours. With this, I have 30 days of live trading. Now what we do is Tuesday, Wednesday, and Thursday. We're trading from 9:30 to 11:30 unless something comes up. So that's 2 hours. So really what you're getting with this course is about 66 hours of instruction, okay? Very good. I got the dates on the website. The next class starts, next week. Now, let's get on to our feature presentation. Hi, Erica. I see you're in the room. I'd like to know, is there anyone who has not heard me speak before? If you just would, let me know, have you heard me speak before? Because I want to go at a little bit more rapid pace since I'm going to bring some new material in here. Okay, well, okay, got some that have not. Okay, all right, well, we'll see how this goes. Patrick, we might go over a little bit. So what is momentum trading? Momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. I always say that, you know, taking the trade is the easiest part. The toughest part is your exit. It really is. So what is momentum trading? We're building a trading strategy off a firm understanding of support and resistance, along with known areas that price is attracted toward moving. And when we see price moving in a certain direction, we have a pretty good feel through our screen time and through the different tools we use of where price is going to move next. Okay? So, what is momentum trading? It's trading directionally up or down. We are riding the price wave rather than reacting to what might happen. Usually this is accompanied by a price oscillator. It's used for intraday and short-term trading, holding over a few days or a few weeks. Last year we held euro for quite a long time as it fell. Today I just want to talk about day trading, just day trading. So when we talk about day trading, the intraday day trader is going to use the daily chart for the big picture, and we're going to use the short-term chart for the tactical entry. As a very general rule, the more volatile the market, the smaller the time frame that you should use on your chart. Now we know that markets only move in three directions, up, down, and sideways. If the market is sideways, we are greatly challenged unless the range is large. So it is imperative to find moving markets. In this presentation, I'm going to talk about the Russell 2000. And so if you're a TF futures trader, you've got to understand there will be times you must expand your horizon to find other futures showing movement, especially if you are strictly an ES trader. I mean, you know those days where nothing happens, okay? But meanwhile, you look around and maybe gold was flying, maybe crude was flying. Wow, the other day we talking about wheat. So there is always a market moving. Now, to identify trend, we want to bracket price with trend lines, daily chart and intraday chart. And we understand this very, very complex concept here. Are you ready? Price will simply bang back and forth between the trend lines, okay? So here we are. Here's daily Russell 2000 today. And you know, you got the trend line here. We've got a trend line here. And the reason we're not really going anywhere on Russell 2000 is because we are locked. We're locked in these lines. So when we break through the line on the daily chart, it will be an event. It will also likely portend continued excellent range in Russell 2000 trading. And by the way, if you've never traded the Russell 2000, the reason people are drawn to it is because the range typically is a lot better than the ES. Okay? Now, I'm going to show you, for the moment, I'm not going to look at the indicator. I just want to look at price. So what we see here, overnight, let me get my pointer. Let's see, I didn't seem to get that. Try a pen. Okay. I don't know why that's not working. I hope you can see my arrow. Overnight, we see that price reversed the downtrend from yesterday. Now, is that really a surprise when we just looked at the daily chart and we see that when we hit the bottom, we go up? That's not really a surprise, okay? So the idea that, okay, we're bouncing back up after hitting the bottom, to me, that's no surprise at all. Because what we're being told on the daily chart is we have to wait for a breakout. Otherwise, we bang back and forth. Russell 2000 does it. You'll see this action repeated across, any instrument for trading. You'll see these types of patterns. So all I want to do before 9:30, now here's the 9:30 line here, all I want to do is just draw my lines and know that when we have a breakout, it might be an event for us. You see PP on the chart. Well, that's pivot point. I use the pivots extensively, okay? Extensively. So the Russell 2000, we at 9:30 immediately shoot it up, and this is all designed to catch the retail trader. They shoot it up, and people think, hey, this is it, breakout, wow. And then it slams down. Now, in about 5 minutes, the Russell 2000 dropped over $500. This is a 10 range bar chart, so each price bar has a range of $100, okay? So in 5 minutes, over 500 bucks, boom. So I like to refer to the first 15 minutes as the killing field, because it really hurts a lot of people. There are breakout trades, and there's people that can trade the open. Wonderful if that speaks to you. Wonderful. But for a lot of people, you probably should wait for the market to settle. It tends to settle around 9:45, sometimes a little earlier. I've got a client who notices it seems to really start selling around 9:38, so I've been watching that too. But as a general rule, I'm not too interested until 9:45. Now, understanding trend lines is just so basic that nobody wants to do it. Everyone is totally infatuated with indicators. But support and resistance is huge in momentum trading because we see probable areas price wants to touch over and over again. Now let's talk about oscillators. Oscillators derive their power, right, from price movement. So doesn't it make sense we need to understand how to read price action? The oscillator will provide a trigger point for entry, basically confirming what we can already see is likely to occur. Now, with all the oscillators out there, this is what traders look like when they're trying to figure out which oscillator to use. Remember the story, right, of the blind men and the elephant, right? Each one has a different idea of what they're touching, right? Same with oscillators. The guy in the back says, hey, this is MACD. This is great. Wow. I know exactly what this is. And the guy in the middle might be looking at RSI, and the guy over here hugging the leg might be thinking, okay, well, gosh, I'm using moving averages here. It's wonderful. But the bottom line is there is an oscillator, right, for every color in the color palette. I mean, I'm telling you, and yet they always derive their power from price action. Now, everyone has their first personal favorite, and in the beginning, I used slow stochastics, MACD, Williams percent R, RSI, Bollinger Bands. Why not? And when you are sitting at home at night, market closed, you can throw up all this stuff on your chart, and you're relaxed, and you can think in a very reasoned way what your next move might be. You cannot do that in day trading because you've got to react. Now at present, in all of my trading, I'm using just one indicator because I wanted to simplify. So I use the Commodity Channel Index, also called the CCI. Now this is the big secret that you won't hear anybody talk about. In a strong momentum market, all price oscillators work, and I mean everything, everything. In a tight range market, all price oscillators are going to lose their predictive value. And here again, all of them. So it's one more reason to monitor several markets looking for momentum, one more reason to have an understanding of price and know when price is in a tight range. Now, the CCI was created by a gentleman named Donald Lambert. I've met Mr. Lambert. Basically, in a moving market, the CCI is shown to lead price. Now that's a big statement there. But I don't want you to take my word for it. In his book, Technical Analysis of the Financial Markets, and this is required reading for these chartered market technicians, John Murphy is the gentleman who shows how the CCI leads price. Now, he only spends about a page talking about CCI, not much. But what I want you to notice here, and I'm really sorry I can't get this pointer working here. Maybe the arrow? Oh, good. Got the arrow working. Notice how, okay, down here, CCI goes up, price goes up. CCI starts turning down. This is where you're getting that first nuance that, hey, momentum might be going lower. And sure enough, we go down. Okay? This is what we're talking about. It leads price. Down here, across the 100, it goes up. Down here, across the 100, it goes up. This is a histogram I'm going to show you in a few slides how to read this. Now, the CCI is a price oscillator. All you need to know is that we're comparing a price with a simple moving average over a selected time span. That's it. Mr. Lambert suggested a 20-day period. Other people have modified Lambert's suggestion for intraday usage, including 14, 6, and 5. Now, how do you calculate this? Well, don't worry about it because most of your charting packages have it done for you. All you do is define the time period. I will show you the calculation, but you know, if I look at something like this for too long, my eyes will glaze over. So, not to worry about it. All I'd like you to know, so that you can start immediately testing this, is the CCI is plotted on a histogram. On the histogram, which I will show you, the 0 line represents major support and resistance. The 100 and 150 line represent minor support and resistance. So this is a dated chart. That's okay. I'm just showing you the histogram. I'll show you today's action later. I've got a 200 line here. That's extremes. I got 150 here. It's minor support resistance. I got 100 minor support and resistance. Here's the 0 line. This is major support and resistance. And what that means is if we are below the 0 line, then we have a bias that price is going lower. That's a CCI bias. Here's the minus 100 line, a minus 150 line, both of these minor support and resistance, and then extremes minus 200. Okay? These Patrick coded these with color so we can see very easily. Green means we are expecting to see this thing move up, and red is saying be careful, we could be moving down. Okay? Whoops. Okay. Now, the diagonal trendline break is a very simple concept. Very powerful, very auspicious how it works. And the rule here is to start drawing it from the plus or minus 150 line. Okay? So let's just talk about the diagonal trendline break. Notice over here, and again later I'll show you today's action. Okay, so diagonal trendline break, price goes down. Look, it didn't hardly goes down and then comes back up. Depending on where you put your protective stop, and we'll get into that, this might have been a losing trade for some. We'd put our protective stop just above this trigger bar, so we would not be stopped out. It'd be close, but we would not be stopped out. But if you missed that trade, not to worry. We got, boy, I missed that red bouncing ball. We have another diagonal trendline break here. And what am I calling diagonal trendline break? I'm calling, we draw it here, we have a touch here, and we extend it out. So that when it breaks here, it is a sell signal. So this was a nice move. Remember that the range is 10, so the range of movement is $100. Now, I did not just randomly pick this. This was from my last presentation, and I did it that day. So for that day, this was the live chart, okay? And a little bit later on, I'll show you today's trading. Here's another one. We came to at least 150. We draw that line, we break it, and down we go. Here's another one. At least from minus 150, we have a touch here. We break it here, and down price goes, okay? And this is what we do. How simple is that? That's all I want to ask the question, okay? Now, for intraday use, same histogram, but we're going to, instead of use 20 default setting, we adjust to 14. 14, this is important. And remember, in day trading, smaller time frames in moving markets with a good range. I like to think that we should trade the rush hour instead of all day. For years, I traded the entire day, for years. And now I only trade in the morning, okay, for day trading. Now the diagonal trendline break is probably the top pattern for profit. There are 4 other patterns I use and teach, but probably 50% plus of the trades are accomplished with the diagonal trendline break. So boom, this is right off the bat, you can start testing this. Prove it to yourself. If it speaks to you, start, utilizing it in simulation. I'd like to refresh the key concepts. You're going to draw the trend lines at plus or minus 150. And why do I say that? Because I've found that the higher you can draw the trend line, when it's broken, it seems to have greater follow-through. Your own testing will have to prove that. Better trades are in markets showing momentum. 14-period CCI for intraday below 60 minutes, okay? And if you can't draw a diagonal trend line, should you really take the trade? That's one thing you can ask. Now the entry rules, I like to use on a small time frame like the 10 range bar. I like to use a confirmation bar. That means I get the trigger and then I want the next bar to print in that same direction, and then I'm comfortable. Okay? I suggest you focus on trend trading and only attempt counter trends after you have mastered trend trading. Now, in an environment where there's not much movement, I'll be the first to admit that the trend trading can, it's rough. And that's why we've got to have no-go rule, and we have to know a little bit about price structure, which I'll get into. This absolutely killed us in the first half of August. I'll be honest with you, okay? And if you look at the price chart on the daily chart, first half of August, it was rough. One of those times where you get in and then all of a sudden it goes against you, and then you're waiting there, and then suddenly out of the blue it just suddenly moves, and you say, okay, where did that come from? So you're going to have those. These are called drawdown periods. Every single trader has it. What we like to think in our methodology is that we don't have more than 2 losing trades in a row, but this has to be proven by each individual trader. And if there's more than 2 losing trades in a row, then either the trader is distracted or the market is really choppy. And so really you should look at price to answer that question. Let's talk about protective stop. This is the best stop I've ever found, quite honestly. It will demand a little bit larger protective stop. But if you're intraday and you're going to go long, place the stop below the trigger bar price or the prior bar, the one that's prior to the trigger bar. Whoever's lower, place your protective stop there. If you're going to go short, you place that stop either above the trigger bar or the bar prior to the trigger, whoever's higher. Now, the wonderful thing about working with these range bars is I can quantify my risk. So on any given trade, worst case, it's probably going to risk about $300. That's your initial protective stop. That is unacceptable to a lot of people. And so let me just tell you, if you're trying to trade the Russell 2000, this guy can drop $250 in a heartbeat. So reconsider what you're trying to accomplish, because anyone tried to trade this animal using a 6-tick stop, I really think it will be a tremendous challenge. Okay? Big time. So, again, these are dated charts, but they're convenient. I did not just pull this out of the air just to show it to you. And we'll get into today's charts. So here's the killing field. Well, you know, obviously, obviously, if anybody traded right off the bat, this is so common. If price has been down in the pre-market, they open and they're going to fake it a little bit and then run it back up. That's very common. If this is your style, this is a huge move. I've seen this move $400 in seconds in the killing field. So just be careful. That's my word. Just be careful. Let the market settle down. All right, here's diagonal trendline break. So protective stop is up here, just above the trigger bar. It is higher than when we tried to retrace. It's higher than that. Okay? It's a mechanical stop. It never, ever changes. Meaning there's no guesswork. Where did I put protective stop? You know, I first started trading minute bars, 3-minute bars. And gosh, by the time you got in the trade, you see the big long candle and you just knew, well, I'm going to get in, but gosh, it's already covered a lot of ground. And sure enough, you get stopped out. So I like the idea that this is graduated in these increments of a 10-tick range. All right, so let's suppose you got into this trade. Well, your protective stop is the bar previous to the trigger. That's right here. This is what I call the confirmation bar. That's the confirmation bar. All right. Exits. Entries are the easiest thing in the world. Exits are the toughest. So profit targets, you decide the target. That can be, right now we're running one contract at 10 ticks, the other contract at 20 ticks, which is 2 points. But yet, if we see that we're moving pretty good, we will gladly expand that profit target higher. Now, I did that 2 times today to my detriment. So, in other words, we banked the first one, and then I said, hey, this thing looks like we're going to move higher. Well, it didn't. So we got knocked out. The runner was I think break even plus 1, and then maybe the other one was break even plus 8. We're always moving that runner up a little bit so that we don't have a loss on that. And then the third time we got out early using targets, and I said, now I bet 3 times the charm this one's going to run much longer. And sure enough it did. We've gotten some of these runs, we've caught those $500 runs, absolutely. Now, you can use a CCI. If it starts turning at the 150 line, crossing back down towards 0 if you were long, crossing the 150 is minor support and resistance. That's telling you, hey, first shot across the bow, just want you to be aware, upward momentum might be leaving the party. And if we cross the 100, well then absolutely out. You can always get back in. Pivot. This is always a profit-taking station. Okay? Price touches the channel line. Well, you're going to find if you start drawing these lines how it's just choreographed. You touch the top of the line and then it rejects and goes and touches the bottom line, then pops back up. So these are profit-taking potential areas. Now, what else have I got here? The blue arrow shows you protective stop. We covered that. Okay, we covered protective stop. I hope you see how effective this is, right? Just beautiful. I want to let you know this is a very robust system across any time frame, and if an action repeats, we can trade it. That's what you must always remember. If the action repeats, we can trade it. Now, for the Russell 2000, I've used the 10 range bar chart. That's what I use now. For years, I used 512 tick chart on Russell 2000, on crude, and on what else? Euro. Also volume. 250 or 500 volume. Volume charts were great on the bond chart too. Okay, I really want activity-based charts rather than time charts, but I will look at a 15-minute chart. I'm not trading it, I'm looking at it just to keep awareness of the bigger picture. Now the momentum trader believes they're in the trade for the long haul, right? They're in the business, I should say, for the long haul, taking a series of trades, converting to cash quickly. In this respect, you are no different than a card player at the casino. You're going to have winning hands, you're going to have losing hands, but you trade your system. The card shark, he trades his system. Runners are for longer term moves. I should say longer term on the intraday chart. I would suggest you trade multiple contracts rather than pin your hopes on a single contract. Paper trade prior to using real money, and understand your ego and your mind and trade with your weakness in mind. This is why it's very difficult when I talk about exits, because people have a relationship with money that is unique to me and unique to you. And this is a problem. This is a big problem in trying to find a one-size-fits-all. Now I want to talk briefly about market structure. If you have questions, I'm not ignoring it. I want to get to the questions at the very end. The market structure is huge. But again, if you're in the business of selling indicators, especially proprietary indicators, right? You don't want people knowing about the basics. Market structure refers to watching repeating patterns on price bars. Well, what are price bars? Price bars are the psychology of the market at that moment in time. At that moment in time, everyone agrees this is what the asset is worth. If we see that the price bars start moving, then everyone collectively is saying, okay, it deserves to be higher, and they're bidding it higher. We always look for repeating patterns on price. This is no different than someone teaching you an indicator and saying, now watch for this pattern. Get ready. No different. The market structure is the basis for classical charting techniques, right? I'm talking about these people that say, oh, we've got a head and shoulders. Oh, we've got here's a triangle. Oh, here's a wedge. Wow, here's a triple bottom. This is all market structure. Remember oscillators derive their power from price. Therefore, watch price for clues. This will help against the chop and grind that occurs in the day trading. This is this morning. Now let's look at this. All right, so here's a classic wedge pattern, right? Just classic. And so just before 9:30, boom, up we go. Now at 9:30, where this line is, this is the typical fake out of the professionals. Okay, run it up a couple, get people thinking, okay, people think, oh, maybe we're gonna go up to this level, yesterday's high. People get really excited. And then slam it down, just absolutely slam it down. So we dropped about over 500 bucks in 5 minutes. And then we go through this grind period. Well, what do you do? What do you do? I have a rule. I don't want to trade if the range is $200 or so or less. I just simply, I don't want to do it because I know this is a grinding type action. Maybe it's going to be 250. I'm looking at it, and then what I do is I draw my lines, right? I'll draw a line, and I want price to tell me, okay, I'm ready to move out. Now, this down here, I don't know if I can draw on this. Let me see. Pen, please work. Nope. Okay. I'll drag this arrow down. Shoot. Bear with me. This is actually a pattern that we look at. And so automatically we see this kind of a formation. And it's a predictor we're going to go higher. And what could I have drawn from here? From here down to here, I could have drawn a diagonal trend line, right? So I got two patterns saying, hey, we probably going to go up. Okay, well, it's the first 15 minutes. I don't trade that, but other people could have taken it. Each bars represents a 10 tick range. So this was a nice trade. So we were just watching this stuff, and then all of a sudden, we just go sideways again. So how can we use market structure to give us a good feeling of where we're going to go? So what we did was we drew, or what you can do is you can draw this line. Mentally I draw the line now because I've been doing this for years. But you draw the line. And what you're looking for is for price to have made a high, come back down and base, make another high, over here, come here arrow, and then fall. And then when we break this level, then we are going to drop. And we're going to go to the next point of support, which on this chart would have been the overnight low. So this is what we were kind of talking about this morning. And the next thing you know, we just grind. We come down, so we are all excited about, I am anyway. These charts do that to me. We're talking about, okay, get ready. Could be a short because we've run these things for some pretty good runs. Price goes back up. Now, If we were doing a diagonal trendline break, we're not quite at 150, not quite at 150, not quite. But we just draw our line here, and we're saying we had a low, we had some basing, we had a higher low. So if we see a break above this level, we have overcome resistance. And up we go. I'm telling you, this is the best thing I can suggest to you for how to break out of these sideways markets. Whoops. Now, this thing went on up. So we got into this thing. And here's another opportunity. I drew the diagonal trend line down here, and up we go. And this is one of those instances where I think the runner didn't do anything for us at all. Here's diagonal trend line break here. We come up, make $100, and then it's like the runner didn't do anything for us. Here's another trade. Notice we're not trying to do any of this business, okay? It's a fast market this morning, and over here it was. And then it just kind of goes quiet. So it's a perfect time to just, rather than pin your hopes and dreams on the greatest trade in the world, take some off and just be done with it. So this was a trade, and then, okay, it goes up. Notice down here, crossing the 150, that's a good signal for what? Upward momentum might be over. And then this trade right here, we enter the trade, diagonal trendline break, and all of a sudden we get involved in all of this business, and it is just gut-wrenching, okay? It is absolutely gut-wrenching because you're using two contracts. And remember, we took this also as a pivot trade. Here's a pivot touch, one bar to confirm, so this bar was entry. And then what happens? Just nothing. So when it goes against you, two contracts in this example, that's a lot of money. But we had reason to believe that we should hold, and I always pound that in the live sessions. We are being told this thing should go higher. And then boom, the magic. Well, you know, we had two of these things fail on the runners, where I expanded the runner and it just didn't work. I think the one runner we got out with $80. So on here I just, okay, this $300 trade, you know, and I said, now three's the charm, it'll probably go up to here. And lo and behold, it did. Well, who cares? We're positive for the day, and now we can enjoy the rest of the day, right? Obviously, you can trade longer if you want. Let me review this one more time because you had a perfect setup yesterday. A high, a low, a high, not to exceed this high. We drew our line, and this called a very nice move, okay? At least until your day trading margin is up and you can get out of the trade. One more time, this is today. A high, a basing, we come up. I honestly thought we were going down again. But instead it goes higher. This one actually almost caught me off guard. Okay? And then you look back and say, wait a minute, this is what we're used to seeing. All right. Now, we look at the charts in an all-encompassing point of view. This is so important. I'm not handcuffed to the indicators. I'm looking at price action. I'm looking at price oscillator. I'm looking at linkage between markets, which is a whole nother topic. but we believe helps us. I cover all that. So we start noticing repeating price action occurs over and over and over, just like the oscillator. So my question is, why aren't you watching the price action? And as far as this market auction theory and market profile and all, I'm not going to get into that, but I'll tell you right now, I am worried about the effect of high frequency trading on that entire side of the business, affecting that. Now, my no-go rules. I'm not interested in Russell 2000 if the range is around 200. And I'm not tight about that. It's 200, if it's 225, 230, 250. I just draw lines on the sideways channel and say, okay, this is pretty tight, around 250, $200. I'm not interested. If price can't break out, then why am I trying to tell it, okay, you break out now? I must let price resolve the issue. This is important. I'm not, this dome stuff, watching how many orders are staged, how many people look like they want to get in, blah, blah, blah. I don't think that means anything against the professionals who are out there every single day trying to take your money. So I must let price resolve the issue. Meanwhile, while I'm waiting for price to resolve the issues, the oscillators are giving all kind of signals, or maybe the moving averages, and they can chop you up. I know you've been there. We've all been there. We've all done that. Let price resolve the chop. Market structure, paying attention to it, resolves the chop. Having a rule where if you lose 2 in a row, you step back and say, what the heck is going on here? Okay? Now remember, mastering any task requires repetition of the same action over and over and over. Like learning to play a musical instrument, right? You got to learn it. You got to spend time on it. I know. I take piano as an adult just to develop my brain, right? You remember when you learned to tie your shoes? That was a daunting task. Trying to learn a foreign language? Well, trading is a foreign language, and it takes time to learn and to show consistency. So stop trying to shortcut the system. You know, find something that speaks to you and focus. For new people, keep the trading simple, very simple. Block out distractions. Become as mechanical as possible, taking a few setups that prove consistency. And your goal is to develop you as your own expert. For me, it's the support and resistance trend lines, moving average, an oscillator, the CCI, pivot points. I'm huge on pivot points. And I choose, for me, just the morning trading to fit my lifestyle. I might have option trades on equities or something like that. That's fine. None of that's edge of the seat business. But the day trading, I like to be fresh and do it. So many people make stuff in the morning, lose it over lunch, and then just are in a fit to try and make it in the afternoon. Forget about fancy and keep your trading simple. Now I'm ready for questions, and thanks for your patience. I want to again thank Patrick so much for the opportunity and the Infinity Futures and the management for allowing me to speak. You want Rooster Call? I'll give you 30 days free.
My buddy works at an agency right now, and what they're doing is digital video. A couple of questions, Martin, if you don't mind.
Yep.
The one question came through, TJ was asking about the pivots. The pivots are just regular daily pivots, right?
Absolutely.
Right. There's nothing, because obviously there's a lot of different ways to look at that, but, it's just, there's nothing fancy there, right?
Correct. What you find is that the pivots are what the machines are using. There are different pivots available. You've got to understand people make a small tweak, put their name on it, and then they try to sell it or they give it away with their name on it because they're trying to make some name for themselves. The markets are using the pivot points that are standard because that's what the old floor traders used.
Right, and to your comment, TJ, about like small differences in the pivots, sometimes you see that among different vendors now because the floor is gone, and some of the charts use settlement as the close. Some use the closing price. We have seen some minute differences from one vendor to the other. So
and different data flows.
yeah.
But the main thing is that the variance should not be very large, and you're going to be fine.
Yeah, I agree. I mean, I agree with that. Most people, and then sometimes if there are some differences, it could be as simple as, the time the chart started, and a lot of times we can pin those down if it's an issue. So just so you know, TJ. Yeah, cool. That's a nice comment from JD about you being one of the 2 best speakers we've had in the last 30 plus days there, Martin. So that's a nice little piece of free advertising for you. There you go. So. Brian, your question about can we follow you for a week free or something? I don't. The only thing I think that Martin is giving away on a trial basis is the Rooster Call for 30 days, which I really recommend you at least try. I mean, it doesn't cost any money, and you'll get something out of it in the mornings for sure. Brian, I think okay, let me put it this way: whenever we work with a third party, educating partner like Martin. Obviously, we're we're a little pensive about our clients spending money on stuff instead of putting it in their account. You know what I mean? I mean, we don't want people going out and buying, $6,500 indicators. They can do that at NinjaTrader and get stuck in that cycle. We're not interested in that. The fact that Martin keeps the pricing reasonable on his classes means something to me, and it's part of the reason why we let him talk about it. So, the three days, live access, or the 30 days, excuse me, and then the class, it's a decent, it's not $20, but it's a reasonable price, and for I think what you're getting, and that's why we allow them to put it out there. I mean, some of our clients who are struggling, they're losing that amount of money in the first, 5 minutes of Monday morning, so that's I think it's a pretty fair place to start, but just to give you an idea, So, a couple of questions that came through. These you must have hit a nerve here, Martin, because people are asking you about the live trading room. Because it's not a continuous live trading room all the time, right? You do this for certain periods of time, right?
I'm only doing this for people who are taking the course, because if I open it up to just anybody, then I can't trade because I'm too busy answering questions.
Yeah, plus it's just a lot. Running a trading room is not easy, and especially if you got other irons in the fire. So I understand that. So for your question, William, your questions about the trading room, it's something that he's doing during the class. So it's like a fixed thing that happens like a few times throughout the month or a quarter. Okay, and you'll get emails from him and stuff, and you can visit the website. He's got a schedule like this, so. It's not like a traditional thing where you might have seen where someone's in the room, every day, 5 days a week, 365 days a year, that kind of thing. The other thing I wanted to mention too, there's something that comes up a lot, Martin, that this is not really related as much to you as it is to me, but I'm going to address it because it comes up in questions all the time, is the ICE, the data cost. We don't, for those of you who are wondering, no, you don't have to buy, Martin does a lot of Russell trading. You don't have to buy ICE data from us. Currently, the ICE exchange doesn't make us charge for the data. Okay, so if you have an account here, you don't have to buy the Russell data for $85 or $95 a month like you do at TradeStation or IB or some other places. So you can keep the fixed cost a little bit less here. There are some data fees for CME, but they're very inexpensive. You don't have to pay extra for ICE or for Eurex data if you'd like to look at Eurex like the DAX and the Stocks 50, okay? So for those of you wondering about that. All right. Good deal. That's excellent. Anybody else have any questions about the methodology, anything about the charting, anything about his charting techniques, about his service, anything that either of us can answer while you're here? Okay, here's a question from Larry. Martin, about can you expand a little bit on your explanation of your interest in range bars versus like regular time-based bars? I heard you talk a little bit about it, but he was curious about that.
The reason that I like to have the range bars is because I can very easily quantify risk with every single trade. If I were to just put on like a 3-minute chart, then gosh, we might have a flood of a big price jump, or some people use a 5-minute chart, and you get in and you're forced to have to use a very large stop, abnormally large stop. So I just like the uniformity of this being just 10 ranges, right? And the Russell 2000 is known for moving, and it's known to have typically a good range. So when this thing starts moving, it's more meaningful to me if I say, okay, I got a trigger. Let's look at this trigger over here. I got a trigger, and I'm in the trade. I let it confirm. Take one off at 10 right there, and my runner's going to try to make another 10. The protective stop goes immediately. Once I take $100, protective stop goes to break even or break even plus 1. Now, I want you to also know that for people who, and I'm doing this, I like to trade this way, but also for people who are thinking maybe we're going to get into a longer term trend or something. Well, there are methods that I teach for staying in these things longer if you do not want to simply use targets. Okay? But I just in the morning, especially today, it was rough on runners. It was rough on runners. But say this trade right here where we got out. Normally, what I do is I will then just expand the profit target up because I expect we're going to hit that overnight high. They always want to do that, and they treat that overnight high and that overnight low very much the same way they treat a pivot. So, we caught one the other day. I don't know if it went. We made $800 that day, but we caught another one. It was $500 run. The thing is that when you catch them, they're just beautiful, and you feel like, oh my gosh, Casey at the bat, and but sometimes it just doesn't work out, and then you say, well, why didn't I just go all in, all out? But I like to answer the question, I like the uniformity of knowing my risk will always be about $300. If I use two contracts, if I'm using 2 contracts, I know mentally, okay, I've got about $600 at risk here in the worst case scenario. Okay, good question.
All right, good deal. I think that about does it. I mean, we're running a little short on time, but I think you were pretty clear about the whole thing. See, everybody, the reason why, one of the things that's refreshing about Martin's take on this is that, again, being on my side of the business, all I hear all day are about the most complicated algo thingies that are out there, and everybody is just so obsessed with taking every last bit of information and try to make sense of it in that 3 seconds that you're trying to decide whether to get the trade on or not. For those of you guys who come to some of our charting webinars, you know that I kind of go off on tangents about this every now and then. I just really think that every now and then we need just a good, simple approach, and that's one of the reasons why I like Martin's calm and sort of somewhat old school way of looking at this, because with all the technology that is out there these days, we have access to more data, more everything, more indicators, more time frames, more markets, more depth of market and bid and offer volume and all that. And I'm not, like Martin said, it's not to detract from that stuff. If somebody can make it work, they can make it work. Fantastic. But I just think that people are getting carried away with it, and I think Martin's approach is very relevant with the kind of struggles I see my customers going through. So that's why we do these. So, Martin, I think that's where I'm probably going to leave it, unless there's something else you want to add. Everybody, sign up for the Rooster Call. I'm telling you, it's a good piece of writing. He writes really, really well. I mean, it's like written in a way where it's like your eyes follow this thing down and then you're done with it. It's a really good thing to get involved with. Then you'll get some email updates from him as well, just like I do. So really recommend you take a look. If anybody has questions that are, platform or brokerage related or something, let us know. If you end up using something of Martin's, if you become a student of his or whatever, let us know and let Martin know, and we'll give you access to the templates that he helped us create on Sierra Charts. Okay, that's for people who take his classes only. That's really all I got. Martin, do you have anything else you want to add, or are we good?
No, when people agree to want to work with me, I don't charge extra for anything else like templates or anything like that.
Right. It's not like you're not buying the indicators. Okay, it's just you just get the template. Right. And he doesn't. There's no password for the indicator setup. You just tell him. He'll tell us. We'll get you the file, and no big deal. All right. Okay, well, that's great, man. I really appreciate it, Martin, as usual. Excellent presentation, and just enough to differentiate from the last one we did. I applaud you. I really enjoyed it. We got a lot of good feedback, and it's relevant stuff. So thank you for taking the time, everybody. Appreciate you guys coming. It's late in the week, and everyone's a little exhausted, but this is Friday Eve, is what we call this here in the office here. Friday Eve is now begun. It's 4:40 in the afternoon on Thursday. So everybody have a great night. Thank you for coming. I'm going to take the screen back from you, Martin, right now and go through some risk stuff one more time, and we'll see you all at the next one. All right? Thank you, everybody. Hey, Martin, thank you, man. Appreciate it. Have a good night.
It's just spinning.
All right, folks. Again, really appreciate it. Thank you, everybody, for coming. Let me go through some risk stuff here in just a moment, and then we'll close the room up for tonight. And barring any issues with GoToWebinar, we'll have this up on YouTube by tomorrow. All right? Cool. Thank you. David, Mark, Cal, Judith, David, again, Michael, Bob, thank you, guys. Really appreciate it. You have a great night. We hope to hear from you soon. Give us a good look. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss. It's not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, folks, thank you. Take care, guys.